Hi, good morning, class. This is going to be sensitivity analysis training for capital budgeting by William France. So what is sensitivity analysis? Sensitivity analysis is a simple technique we use to see how changing key variables can affect our project's results. Imagine you're planning a big event and you want to know how the changes in attendance or costs can impact your budget. A common way to visualize this is with a tornado diagram as seen on the right-hand side. This is a horizontal bar chart showing the effect of various changes. The longest bars indicate the variables that have the largest impact on the project. This will help us easily identify and focus on the most critical factors. So the first step is going to be that we identify the main factors that can affect our project. For instance, if we're launching a new product, an important variable might include how many units that we sell, the price per unit, or the cost of our material and labor, as well as the interest rates that are on any of our loans. The next step is going to be set realistic expectations and ranges for these variables. If our expected sales volume is typically 10,000 units, we could consider a low scenario of 7,000, a likely scenario of the 10, and an optimistic scenario of maybe 13,000. We use historical data or expert insights that can guide us in these scenarios. To calculate the impact, we're going to adjust each variable individually within those set ranges. For example, like we had mentioned, reducing the sales volume to 7,000 units, how does the profit change? Or if our labor costs increase by, let's say, 10%, how does that affect our cash flow? Doing this clarifies how each factor influences our project's outcome. So now let's analyze. After we've pinpointed and tested all the variables, we can analyze the test results carefully. For example, we might discover that sales volume significantly impacts our profitability. This identifies sales as a critical area requiring close management and monitoring. After recognizing our key risks, we can incorporate them into our budgeting. For instance, a project that is sensitive to sales fluctuations might need to offer a higher potential return just to justify keep going on with the project. Some projects with more predictable outcomes may be safer and therefore more attractive even if they don't have as high of returns. To summarize, sensitivity analysis is a key tool to help us identify potential risks clearly, guiding smarter, more effective project management decisions. By focusing on the critical factors, we improve our chances of project success.